let's move on then. Nilesh Shah from Envision Capital is our market master today. Nilesh, hi, good morning. Good to have you in the studios. What has happened in last 2 days? This really came out of nowhere. Or did you have a sense that maybe the market was getting a bit complacent? And does this change things a bit for our markets?
Well, yes, I would to some extent say that the market was beginning to get a little complacent, thinking that essentially the flows towards emerging markets would continue and that the worst was behind us. And I think in the case of India, I think the expectations were that the election outcome between April and May would be more decisive. So I think that was essentially what was kind of pulling up sentiment, lifting the sentiment and taking the markets higher. But clearly, I think the fact that there is virtually like a contagion in the emerging markets, more so on the currency side, is something which is kind of, negatively surprised the markets.
Nilesh, hi, good morning. And it's good to have you as our market master today. That's the new segment that we started. So we'll get a couple of our money control boarders to also, ask you their queries. But before that, what is your expectation from the RBI policy today? And do you think this will just be another one-day event that will be forgotten and not move the needle of the market? Or is there something in the contours of this policy which could impact market sentiment?
Very unlikely that this policy is going to impact the markets in any significant manner. I think the tone is going to be hawkish. I don't think the RBI governor is going to take the eyes off inflation. But I don't think that will kind of trigger a rate hike. It's very unlikely that there would be a rate hike. Probably interest rates will be kept unchanged. But the message would be that we'd continue to be focused on inflation, and probably there'd be a kind of a undertone indicating that it's going to be CPI, which you need to kind of look forward to going forward. So I think unlikely there'd be any rate change, and it's unlikely that this policy will have any significant implications for the equity markets.
Okay, well, that was actually our first question from our on our message board. Abhishek Deshpande, he wanted to know whether the RBI's credit policy will turn the wind for Indian equity. Well, I guess you answered that. So we'll move on then.
Yeah, we move on. Nilesh, what about the portfolio positioning now? Because the year has again started the way we had last year. Only IT is doing well. Of course, today we've seen some profit booking, but the bank nifty is down 7% for the year. The capital goods index is down 8% for the year, and even the pharma stocks are actually down this year. So, how would you position your portfolio now?
Well, I think there's an interesting trend in our Indian markets. I think this trend has not been there just for 1 year, but if you look at the last 5 or 6 years, the market opens at a particular high at the start of the year. But it's rare to see a situation where the markets do not come off from those levels. And I think if you look at this data right from 2008, I think in 5 out of 6 years, you'd find a similarity where the markets open at a much higher level, the Nifty. And then during the course of the year, the markets do give you a significant correction. And I don't expect 2014 to be any different from the trend of the last 5 to 6 years. I think in terms of portfolio positioning, clearly we expect technology, pharmaceuticals to continue to outperform. I think these are sectors where, because of the market correcting, if you see a correction there, you need to essentially buy on declines rather than sell them off even at a small rally. So I think the outperformance that we've seen in technology, pharmaceuticals, I think is something which is likely to continue even for 2014 and maybe even beyond, given the kind of strength that you're seeing in technology spending in the US. And I think the commentary that you see from all technology companies, I think across the board, you're clearly seeing a fair bit of positivity in terms of the guidance going forward or the outlook going forward. So I think technology, pharmaceuticals will continue to outperform. I think consumer will remain a very mixed bag. I think you'll have to take a company-specific view, the way technology was a few years back, where individual companies outperformed and there were a lot of companies which were laggards. I think something similar could emerge on the consumer side. But yes, I think these are the 3 sectors where you'd ideally want to kind of remain overweight for 2014.
Actually, I want to take that point about consumers ahead, because today HUL is down 2% post its numbers. We've seen a lot of concerns coming in from the likes of Dabur, etc., about a slowdown in discretionary spends. Do you think that you should use this as an opportunity to buy into some of these consumer names, or do you think for 2014, at least for the first part, until the slowdown continues, you should just leave those aside?
I think investors should continue to kind of hold these positions. We've already seen some kind of underperformance or correction in a lot of these stocks. Some of these stocks, I mean, right from HUL to Godrej Consumer, have already corrected about between 10 to 25% from their highs that we've seen in the last couple of years. Does that make the valuations terribly attractive at these levels? The answer is no. But I still think that you would see a fair bit of resilience in them. You're probably seeing margins bottom out. You're probably seeing volume growth bottom out. And our sense is that consumer spending will probably pick up over the next maybe 6 to 12 months. So I still think that that remains a very strong structural growth story from an India standpoint. And I clearly believe that the corrections that you see, I think you should use them to buy into some of the consumer names. I think what could be more rewarding would be to identify individual growth opportunities within the consumer space rather than take a very broad brush call on the sector. And it's quite possible that individual companies, more from a bottom-up approach, could potentially outperform some of these bigger names.
So, would you like to give any names? I mean, which look interesting at this point in time?
Well, the companies that we own are companies like Symphony, Cable Care and Clothing. These are some of the companies that we own, where these companies continue to do well fundamentally. I mean, these companies have announced the results only over the last 2-3 days.
What was the first one you said?
Symphony, okay. Which is an air cooling company, Cable Care and Clothing. These are some of the companies which have just announced their numbers over the last 2-3 days. And if you really look at it, these companies have reported growth rates between 15% to 30% with margins pretty much intact, which I think is very good. They're trading at steep discount to some of the big names like HUL and the likes. Obviously, there are some risks associated because these are mid-cap companies. Liquidity is a challenge and things of that kind. But I think from a very bottom-up approach, if you were to kind of take a 2 to 3 year horizon, these categories in which they operate could be substantially bigger than where they are even today. And therefore, there is a potential for a re-rating in some of these companies. So I think you need to take a very bottom-up approach in the consumer sector rather than go for some of those very obvious names like HUL, Dabur, Marico, Godrej Consumer.
Okay, since you are in stock talking mode, let's make the best of that. We've seen a lot of mid-caps, do well, especially in some of these auto ancillary names like Amara Raja, Escorts, etc. What are the stocks that you will be picking in the mid-cap space now?
No, I think within the mid-cap space, we continue to like just IT, pharma, consumer. I think these are clearly our overweight sectors, even in the mid-cap space. We actually see a lot more value in the mid-cap names. I mean, even if you look at technology, the tier 2, tier 3 names, there's clearly more value. They're trading still at a significant discount to the larger names. Obviously, they deserve to trade at a discount because obviously they're not as big as some of the bigger names, but clearly valuations are more attractive in the mid-cap space. I think on the auto ancillary or the auto components,
I
think the companies that we own are companies like Persistent. I think that's a company that we've been owning for a while. We continue to like it. It has a very differentiated business model. But I think on the auto component, auto ancillary side, I think you've already seen a steep run-up. And we would be very cautious on those names at this stage of the market, given the kind of run-up that we have seen, and that the domestic market on the auto side doesn't seem to be picking up as yet, and that could clearly be the downside for a lot of these stocks.
Nilesh, the problem with some of these mid